Hey guys, how's everyone doing? I'll just wait for a few minutes, 1 or 2 minutes, so that everyone can join. And once they join, we'll start. Awesome. How's everyone doing today? I see we have almost 200 people here. So we'll just wait for a few minutes for people to join. And today, what we're going to do is we're going to do a beautiful topic which is called Stock Market 101, right? So we're going to understand how the stock market is going to work. So we'll just wait for a few people and then join. We'll start, yeah? How's everyone doing this evening? Everyone's all right? Everyone's good? Greetings from FMS Delhi. It's going to be a really good, interesting session for all the people who have not invested before, and this is the first time that you're planning to invest or you want to know what the stock market is. Today's episode is going to be quite fun for all you guys. Yeah. Very good. Very good. Cool. So, should I begin? I think I'll wait 1 more minute and we'll start. Yeah. Don't want people losing out on some knowledge today. Okay. I think we can begin. So, guys, let me begin. Yes, greetings from FMS Delhi. Yes, hi, guys. Hi, hello, everyone. So, my name is Shashank Udupa, and I am going to do a session today on something known as Stock Market 101, which is stock market basics for a lot of people who want to understand and learn how the stock market works. So, what we're going to do. What we're going to do is we're going to go through this presentation. I'm going to show you a presentation and we're going to talk about the different things that are there and different things that are required and you should understand when you're investing in the stock market. Yeah. Awesome. By the way, I'm going to keep this very interactive. I have your comments here. I'm watching the comments. So anytime you have any question, you can shoot your comments here and I will take them on stage and answer it. So don't worry about it. There's no such thing as a stupid question. We're all here to learn. So any question, you can throw it up. No issues at all. So what I'm going to do is I'm not going to waste anyone's time. I'm going to quickly start the presentation. Yeah. Awesome. So as I said, quick introduction. My name is Shashank Udupa. I am a YouTuber and an ex-investment banker. I currently have a company called Avalon Scenes, and I love investing in the stock market. I have a lot of passion for investing in the stock market. Now, in today's episode, I'm going to talk about why you should start investing young and early in the stock market. Now, you might have heard that a lot of people keep saying this, right? A lot of people are like, you know what, you should invest early, you should invest early, but they don't tell you why you should invest early. And today we're going to do something very similar. I'm going to tell you why you should invest early, and it's not some generic thing we're going to talk about. We're going to talk about massive facts back to it data. Okay. Now I'm going to play a quiz with you guys. I'm going to show you 10 of the top richest people in the world. I want you guys to spot the odd one out. Got it? Hello. One by one, you guys have to spot the odd one out. Yeah. Bill Gates, Elon Musk, Jeff Bezos, Mark Zuckerberg, Warren Buffett, Larry Ellison. We have Larry Page as well from Alphabet. We have Sergey Brin, and we also have Mukesh Ambani. So, out of all these 10 people, I want you to put in the comments below, who do you think is the odd one out? Who's the odd one out here? Right? I'm going to wait for your comments. I'm going to watch your comments. Let's see if people can get it right. So, Prabhat says Larry Ellison. Abhishek Dutt says Warren. Kshitij Garg says Warren. Rahul says okay. A lot of people have mixed answers, which is quite interesting. So the correct answer is, let me do some build up. Warren Buffett, right? Now the reason why it's Warren Buffett is because Warren Buffett actually started investing at the age of 11, right? He was this guy who loved numbers, who loved understanding numbers. He could know how to read a stock very early on in life, and he started investing at the age of 11. Yes, and he knew he was going to become very rich only because he knew this beautiful technique called compounding. Right now, we've all heard of compounding interest. We've heard about simple interest. We've heard of compounding interest, but very few people know how actually compounding interest works in the stock market, right? The magic of compounding basically requires time. So the earlier you start, the faster you get rich, right? That's the magic of compounding. And if you know how that works. Now, look at this. 96.8 billion of Warren Buffett's wealth 99.8 billion of his wealth came on his after his 65th birthday. So till his 65th birthday, he was rich, yes, but most of his wealth was accumulated over time, and it took a lot of time until his 65th birthday, right? Why am I saying this? Because a lot of people have this urgency or have this need of making money today, tomorrow, day after tomorrow. It doesn't work that way. It takes time for you to build wealth, and it's built over a long period of time. Now, if you look at this compound interest, right, it is defined basically what is compound interest, also known as the eighth wonder of the world. It is defined as the interest you earn on an investment's interest. So, for example, to make it in simple terms, if you invest 100 rupees in something and then you get 10% return on that, you get 110 rupees at the end of the year. Great. Now, when you get the next year again, if you get 10%, you don't get 10% on the 100 rupees. You actually get 10% on the 110 rupees that you made last year. So basically that extra 10 rupees that you made because of compounding interest, you will earn interest on that 10 rupees also. So in the next year, you'll actually be making 121 rupees instead of 120. So that's how you start growing with respect to compounding interest. Now, let me show you some data and let me show you some chart with respect to this. Now, if you look at the table on the left, right, you will see simple interest and compound interest. Now see how compound interest, when you all start with 10,000 rupees and every year just assume that it's going to grow by 10%, not more, right? Every year 10,000 becomes 11,000, 12,000, 13,000. You'll be like, okay, Shashank, this is very slow growth. It's very slow. How do I gain more, how do I gain more returns? Now if you look at year 15 or you look at year 20, you will see how compounding is actually kicking in, right? You'll see how compounding is actually kicking in, because it suddenly goes to 67,000, 74,000, 81,000, and 98,000. You see that every year, because of compounding interest, you're not making 1,000 rupees anymore, you're making much more than that. And if you look at the chart that I've shown here, until the 10th year, there is not much difference between simple interest and compound interest. It's almost the same thing, right? But immediately after the 10th year, it just directly jumps a lot from the 10th year and actually goes into 25th year. It starts spreading a lot. And when that happens, your wealth starts growing over a long period of time, because at that point, it's accumulated so much that it keeps compounding on that wealth. So it is very insane, right? Now, the reason why people keep saying that you should invest early, you should invest early, you should invest early, is because you build this habit of saving. Now what do I mean by build this habit of saving? Now if I consciously at a very young age start investing almost every single day, I start building a discipline to start investing. So every time I'll be like, okay, you know what, every first I'm going to invest, right? I'm not going to wait. Every first I will invest like a normal person. Now when that happens, you start building this habit, and when you build this habit, slowly you will gain wealth over time, and you'll have this discipline of investing. Because if you constantly keep investing every month, if you keep investing diligently without spending first, invest first, you will make a lot of money when you become slightly older, right? And if you start early, if you start in your 20s, then you also have compounding interest to work for you on that perspective. Now, if you look at this, right, why invest in stocks? Right, you might be like, Shashank, there are, I want to grow my money. Now I want to grow it by 10%, 12%, 15% year on year. But where do I invest in? And there are something known as investment classes, right? So stock is an investment asset that you invest in. Now, why invest in stocks? Because basically I'll tell you what the stock market means, right? The stock market, by literal definition, means a stock or a share represents ownership in a business. The stock market refers to the collection of markets and exchanges where regular activities of buying and selling and issuance of shares of publicly held companies takes place. Now, these activities are conducted through an institutionalized formal exchange or OTC marketplaces, which operate under a set rule and defined rules and regulations, right? So this is basically a small brief about the stock market. Now, the most important thing here is inflation. Now, a lot of people don't know what inflation is, or a lot of people know what inflation is, but you have no idea what it does to your wealth, right? So let's talk about inflation. Now, inflation is basically the increase in the price of goods or services over a long period of time. Okay, simple fact: increase in the price of goods and services over a long period of time. This leads to higher purchases and lower purchasing power, right? It leads to higher prices and lower purchasing power. Now basically you might have heard this saying. How many of you all have heard this saying? Your parents would have said this, that mere zamane mein I used to get aloo at 85 rupees, 5 rupees, and now I'm getting it at 15, 20 rupees. Or maybe I was getting a samosa for 3 rupees and now I'm getting a samosa for like 20 rupees. Now that is basically inflation, right? Now inflation in India basically varies between 5% to 7%. Okay, basically varies between 5% to 7%. Now, if you look at inflation, it is basically the devaluation of purchasing power of money. Basically, the money what you have. So, for example, if I have 500 rupees and I keep it under my pillow, and then I come back after 10 years and then take that 500 rupees out, even though it is 500 rupees, it does not have the same value. Why does it not have the same value? Because 10 years ago I could have bought so many things in 500, even though currently it's still 500, but I can't buy the same things. Why? Because inflation has kicked in. So that 500 actually in reality is slightly lower right now. So that is how it works. Got it? Simple funda. Understood, hopefully. Nice. So this is how you see that inflation works. Purchasing power of money goes down from 92 to almost 46, and it keeps going down from that perspective, right? Over a long period of time. Now, if you look at stock markets, basically, they have beat inflation. Now, everyone has to beat inflation, at least beat inflation. So if you know that inflation is 5 to 7%, your goal or your target should be that I should at least beat inflation some way or the other, right? Or else it's almost equal to losing money. Now, if you look at inflation in the last 25 years, if you look at the compounded annual growth rate, right, CAGR it is called, last 25 years, inflation is at 6.73%. Nifty 50 has gone up to 12%. That means it beat the inflation almost 2 times, right? But if you look at FD is not beat inflation. FD is actually at par with inflation. So instead of keeping your money in an FD, it makes more sense to start investing in gold and keeping your money in gold, right? Because in gold has actually beat inflation by 9.82%. So that is why inflation is super important, and stock markets in the past have historically beaten inflation time and time again. Yeah, got it? Now, any questions here, guys, so far? I'm looking at the comments. Any questions? I'll take some questions from you guys. Okay, you can keep throwing your questions. I will take them and answer them one by one. Yeah, no worries. And also in the end, I will talk about, and I have enough time for you guys to ask any questions related to the stock market also. Now, let's look at the top 5 performing stocks in the last 25 years, right? Let's look at the top 5 performing stocks in the last 25 years. Now, in the last 25 years, if you had 10,000 rupees and you invested 10,000 rupees in 1995, you just took 10,000 rupees and invested in these 5 stocks: Berger Paints, Shree Cement, Eicher Motors, Pidilite, and Infosys. Now, I have a quick question for all the people in the chat. If you look at the third stock that is there, the one with the horse, right, Eicher Motors. Now, do you know what they manufacture or what they produce? It is a very famous two-wheeler that they produce that a lot of people in India use. Can someone tell me in the chat what do they actually manufacture or what do they actually sell? Right, it's a two-wheeler company, very famous in India. So if you had invested 10,000 rupees in 1995 over these 5 companies, today it would have been 20. It would have gone, that 50,000 would have gone up to 1.68 crores in the last 25 years with a CAGR, which is compounded annual growth rate, of 26.2%. Mind blowing, right? Insane. Now, yes, a lot of people are saying Royal Enfield. Yes, it is right. Royal Enfield bullet bikes are manufactured by HS Motors. Apart from Royal Enfield, they also do a lot of other things like tractors, etc. But yeah, they do a lot of things. It's very important for you to understand that. Now, if you had again invested 50,000 in 1995, your money would have grown to 1.68 crores in the last 25 years. Mind blowing. Now, what is financial freedom? Coming to the next point, financial freedom, right? Now, what is financial freedom and how you should get passive income over active income? Now, there are 2 types of income, guys. The first income is active income, which is your main income that you get from your salary. The second income is basically something known as passive income, right? This is something that just happens after you invest from your active income. So active income is one thing, right? Passive income is something else. So when your goal should be trying to make passive income greater than active income, right? Now, a lot of people in India focus too much on passive income and not on active income, right? Whereas if you take 1 lakh rupees as your active income and invest some 50,000 rupees in your passive income, whatever that money comes from passive income, that becomes very important, right? So passive income is very important for you to grow your money, and you should definitely find different ways to enhance that passive income, because active income you make but grow from passive income. Now, if you generate passive income, right, so that whatever you want to do, you get something known as financial freedom, where you're saving, passive income comes in, remove as much debt as possible. You have to manage your money and reduce your expenses so that you increase your investment. So basically, these are the few parameters that you should pay attention. Now, another thing that we will look at next is how to invest in stocks. Now, a lot of people have this question saying how to invest in stocks. It is very confusing to invest in stocks. Here we're gonna make sure you understand how you can invest in stocks. But before that, I'm gonna wait for another 30 seconds. If you have any questions, please shoot it in the comment box and let me know. Yeah. Any questions? Let me know. Okay, no questions. Okay, let me continue, guys. Now, when you're investing in stocks, there are two things. One are stocks and one are mutual funds. Now, there's a difference between stocks and mutual funds. So, stocks, nothing but you directly investing in stocks, right? Stocks are nothing but you directly going and taking ownership in stocks, right? But if you look at mutual funds, there's something slightly different, and we will look at mutual funds from a different angle. Now, mutual fund is basically very something similar to the stocks, right? But what they do is mutual funds basically invest in a combination of stocks, right? They don't do anything much different. They invest in a combination of stocks, and there is a fund manager who is an expert in managing stocks, who will come brings his expertise and says, okay, this is how we manage the mutual fund. Now, what happens here is, guys, that for all the people who don't understand the stock market, who don't know how the stock market works, it's so difficult to find out how to go invest in the stock market. This becomes slightly easy for them because they can go invest in a mutual fund, and the fund manager brings in that expertise, right? The fund manager will actually come invest that money for you, and at the end of the year, obviously the fund manager will take a small fees from you, right? And that fees is known as expense ratio. So expense ratio is something that we will learn separately later on, but that is something that happens as well. So mutual fund, you can invest. There are different types of mutual funds, so it's always good to learn about the different types of mutual fund, and they will manage it for you. Now, have you heard of something known as SIP? Right, you might have seen a lot of ads in the past about SIP and how SIP works with compounding interest. Let's look at that. So, how many of you all, first I want to ask this question before I go to the next slide. How many of you all know what SIP's full form is? Now, we saw a lot of ads coming out some time ago about SIP Karo, SIP Sahi hai, SIP is amazing, we should do SIP. Basically, SIP helps you to get power of compounding. Now, what is SIP exactly? SIP is known as, for all the people who didn't know this, SIP is known as a systematic investment plan, right? Systematic investment plan, not sequential, Kuldeep, systematic investment plan. Now, systematic investment plan basically means every month or whenever you can program this to automatically start investing in the company, right? Investing in any kind of mutual fund that you want. Now, I'll tell you why this is important. Right, early on, we didn't have something known as SIP, which was an automatic saving plan. Now, we are humans, right? Let's assume that I get my salary on first, and I said every fifth tariko I will go invest my money somewhere or the other. I just start my investments. But sometimes what happens, maybe on the fifth I'm not at home, or maybe on fifth I'm not well, right? And I have to open my bank account, I have to go open my broker's account, actually find out what to invest in, start investing in that. It's a lot of manual effort, and it takes a lot of time to invest also. So a systematic investment plan, basically what it does, it tells the mutual fund that, listen, take this money, take 5,000 every month from my account, 5,000 rupees you take every month from my account on maybe the 5th or the 10th of every month, and you automatically invest it into this mutual fund that I have selected. So you do it automatically that way, right? 5,000 rupees, you put it here. Now, every month, like clockwork, without you even moving a button or without you even touching anything, SIP will automatically take it from your bank account and put it in the mutual fund. Now, why is that important? Because now you're automating savings the way you see it. So it is very cool from that perspective, right? Now, SIP can be done by you can do it yourself as well. SIP can be done by yourself. You can do it from your brokers also. So SIP is something that you can do, you control it, you can stop it whenever you want, you can increase it whenever you want, you can change it whenever you want. It's all in your hands, right? Usually the frequency of SIP is usually monthly, on a fixed date, because in India, everyone gets their salary on the, usually everyone gets their salary on a monthly basis. That is why, right? Very good. Next, now, if you had invested SIP, okay, assume you're investing SIP and you invest only 5,000 rupees every month today. From today, every month 5,000. Matlab, in a year, 5,000 into 12 is around 60,000 rupees. And assume every year you're getting an average of 12%. This is how your net worth will start looking like. In 20 years, you would have accumulated 50 lakhs. So if you're 20 right now, and by the time you're 40, you'll have 50 lakhs in your bank account. Now let's take it one step ahead. If you are going to 30 years, your 50 lakhs has now become 3 times to 1.7 crores. Damn, in 10 years, it's gone up to 1.7 crores, right? Now, this is why, because compounding is also kicking in. Now, if you take that just little bit more from 30 to 35 years, look at how 1.76 has now become 5.94 crores. Right? This is assuming you invest 5,000 every month for a long period of time. Now, it's not difficult to invest 5,000 every month over a long period of time, because most of us take that money and do time pass and spend it somewhere or the other. But every month, if you can promise yourself, do an SIP and just keep investing 5,000, this is how your bank balance will look like over a 35-year time gap. Now, coming to another very important slide, stocks. Now, when you invest in stocks, guys, please understand this. I know most of you all have seen the bull run right now. We're seeing a lot of IPOs coming. But when you invest in stocks, always invest for a long period of time, not for a short period of time. So do your own analysis. The reason why I'm saying do your own analysis is because I have seen, and I have friends like this. I'm pretty sure you guys have friends. You know that one guy will call you and say, "Hello, Shashank, Sunna, buy this stock. This is a very good stock. Trust me, it is damn good. Buy it." Right? And me, who does not understand, who don't know what the stock market is, will just be like, it's a good stock. Okay, I blindly buy it without any checking, and I'll invest most of my money because you told me it's amazing. Now you are depending on someone else who's done his research. Maybe he's done it, maybe he's not. Maybe he's invested only 1,000 rupees and you put in 10,000 rupees, and that's a lot of money for you, right? So always do your own research, because if tomorrow something goes bad, you can't call your friend and be like, you know what, where's my money, can you give me my money? He'll be like, no bro, I can't give you the money. Next time we'll make more money, right? So please don't fall into that trap of listening to other people. Always, always, always do your own analysis. Next, now, very important, fundamental analysis. Okay, fundamental analysis. Now there are two types, right? Two types of analysis that you do when it comes to the stock market. One is fundamental analysis, and one is technical analysis, right? One is fundamental analysis and one is technical analysis. Now, what is fundamental analysis? Let's look at that. So fundamental analysis is a method of measuring a stock's intrinsic value by examining all the factors related to economic factors and financial factors. What do I mean by this? Fundamental analysis is the method of measuring stocks. And what do I mean by this? Basically, what fundamental analysis does, it basically understands everything about a particular stock, right? It understands everything about a particular stock, and basically anything that can affect a particular stock you need to look at. Now, a lot of people do this mistake when they do stock market investment. When I say, guys, how will you tell me whether a stock is good or bad? Please tell me. If I ask you guys, how is the stock good or bad, you tell me, what would you say? Just look at the profit and loss, just look at balance sheet, and I think it should be good, right? Profit and loss, balance sheet dekh liya, so I think this is a good stock to invest. But that is not how it works, because the profit might look good, the balance sheet might look good, but do you have guarantee that this will do well in the future? Do you have guarantee that this won't be affected by something else? What if something that happens in China is going to affect your stock, right? Which is a macroeconomic factor. What if something that happens in US affects your stock? Maybe what if the government comes and changes a law tomorrow? Will that affect your stock? Like, for example, in the energy space, a lot of laws keep changing, right? In the energy sector. So it affects the companies. Even though the revenues are good, suddenly it starts affecting the companies. So fundamental analysis, not just looking at the profit and loss and balance sheet, but you sit and look at everything, like all the Janam Kundli, right? You have to look at everything about a particular stock. Who is running the stock? Who's the management? Okay, is the CEO a smart guy, or is it someone's son who's just come without any idea, right? Because he's the guy who's taking your company to the next level. So you need to understand the history, the vision for the future, and every year are they promising and delivering what they are saying. If that is the case, then your fundamental analysis on a particular stock is good. The second type of analysis is something known as technical analysis. Now, technical analysis is completely opposite to fundamental analysis, where fundamental looks at long-term investing, stock price, but technical analysis is based only on the stock price and volume data. This is where the charts and the patterns come into the picture, right? Now, price action is used as an indication of how market participants have acted in the past and how they might act in the future. What this means is that we, after using technical analysis, right, all these guys use charts and patterns and trends, resistance level, support level, different type of indicators, basically to do what? Basically to predict, right? Basically to predict whether the stock market will go up or will it go down. If it's going to go up, they will take advantage. If it goes down, they will take advantage of that also. So technical analysis basically looks at numbers, data and they try to crunch it and make sense out of it, right? Now the idea is to identify trends and patterns so that they can take a good call and they will make money out of that. Good questions coming in. We'll take all of that in a few minutes. Yeah. Now some other things to look at when it comes to investing is you need to look at some big terms, right? For example, what is big data? You need to look at what is algo trading or algo trading. Okay, algorithmic trading. Yeah, and then there is robo advisors. Now basically big data basically takes all the data that's there in the stock market. You crunch that data and try to get some effort. Trying to get some data out of that, relevant data, so that you can use it to make a decision. You take that relevant data, give it to an algo trading software and say, you know what, automatically do this and automatically do that, and this will help us, whether it takes a buy or a trade. Basically humans don't get involved in this. It completely happens directly from the machine, right, out of software. Then we have third thing called robo advisors, which are basically online platforms that give an automated investment advice based on your some questions that you answer. Now another thing is that stock market is risky, right? No if and but about it, right? Stock market is risky, but there is a way to reduce risk. The way to reduce risk is, one, you have to keep holding stocks for a long period of time. First of all, you have to invest in good stocks, not in bad stocks, and hold it for a long period of time. Holding it for a short period of time will not make it good for you, right? Because if you have seen the stock market over a long period of time, it has only and always gone up. It has not gone down. Right now, you have to invest in a long period of time. If you don't understand how the stock market works, it's fine. You can invest in mutual funds, and if you still don't understand that and you want to get lesser risk, right? You're like, okay, even mutual funds are risky. Then you can invest in gold also, right? So if you do all these three things, the risk of you investing becomes very, very, very less, right? Next. Now look at this, right? Now these are some resources that are there for you. Now I'll tell you what you guys know are very lucky. I'll tell you why you guys are very lucky. You're super lucky. The reason why I'm saying you guys are super lucky is because in today's world, if you want information about the stock market, it's so easy for you guys to go online and learn, right? On the Groww channel, we put so many videos. You would have seen me putting a lot of videos. There's so many amazing creators putting easy to digest content about industry analysis, about stocks, what's happening with shares, dividends, bonus. So it would be great if you guys go there and just consume this knowledge, because everything's free, right? Just go consume this knowledge, and there's knowledge everywhere. There's a blog, there's a digest. You should follow Groww on Instagram as well. And basically there's something known as masterclass that happens every weekend. You should definitely get in touch and do that also. You have to definitely do the masterclass as well. Now that basically, guys, sums up the entire presentation. How was that? Let me take some feedback from you. How was that? Was that good? If you liked it, click on the like button, because I only see 36 likes over there. So please click on the like button. So let me just close all this. Yeah, very good. So Kuldeep Singh has a good question. Look at this, right? So Kuldeep Singh said, some stats would have been good to show with considering inflation into the account, right? You spoke about Royal Enfield. What would it be 50k if I consider inflation in the account of time value of money? Which is very, very, very good question, Kuldeep, right? Now if you had invested 10,000 rupees in that time, right, that 10,000 rupees would have been massive right now. How much would it have been? Let me go check that slide once again. That 10,000 rupees would have been 25 lakh rupees. Now that 25 lakh rupees is as of today, right? With inflation with inflation put inside, that 10,000 rupees would have been 25 lakhs today, inclusive of inflation. Now I'm not saying 10,000 rupees is very cheap in 1995, right? 10,000 rupees wasn't cheap in 1995, but 10,000 rupees to invest over a period of 365 days in the year 1995 was possible, right? So even after factoring inflation, you will get 25 lakhs today. Now you think about it. Is 25 lakhs today good or bad? It all depends on percentage, right? Now why I'm saying it all depends on percentage is because if 10,000 rupees gets invested, right, and inflation is at 5% every year, but you are compounding at 20% every year, so you're not only beating 5% inflation, you're getting 15% extra also year on year, and that keeps compounding, right? So inflation goes up 5%, but you keep going up 25% or 20%, and when you do that, that's when you beat everything in the stock market and make wealth. So very good question, Kuldeep. Nice. So any more questions, please shoot. I will put them on this and we will figure it out, right? And you can put your hashtags as well. I see a lot of people putting hashtags. So Kumari has a good question. How to analyze the market risk before investing in stock? See, market risk is there, right? So a lot of people get scared and they invest money, and then as soon as it goes down, they'll remove it and run away. But you also need to understand that good stocks over a long period of time, right? Good stocks over a long period of time will ensure that they become profitable. What do I mean by good stocks over a long period of time ensure they become profitable? If you had seen the web series Scam of 1992, at that point the stock market was trading at 2000 rupees. Now it is at 56,000 rupees, and good stocks will survive. And if you feel that good stocks, I don't understand how to find good stocks, invest in mutual funds or invest in ETFs, invest in the index itself. There are index funds also that you can invest in. So all these things minimize your risk potential or risk exposure. So good question, Aarti. Yeah. Next. Okay, this is very important. How to find good companies? There are many publicly listed companies in the stock market. Very good by Priya. Now, the stock market has close to around 4,000 to 5,000 different stocks that are publicly listed stocks, right? Now, I understand it is, one second. I understand it is quite difficult to see which is good, which is bad. But every industry, the stock market is divided into different industries, and every industry has three or four big players. So it is easier to first look at which industry is good, right? Okay, I am now sitting in COVID time. What industry is good? I feel the IT sector is good. I feel, maybe the banking sector is good because lending will happen. So if banking sector is good, go find the top five banks, right, that are there by market cap. If the IT sector is good, go see who the top five are and see, do research. So every time you do research like that, go from a sector overview perspective. Instead of finding 5,000, find which sector is good. Automatically you eliminate all the other companies, right? So you don't have to waste time on that. Got it? Very good. Very good. Very good. Good question. Good question, Priya. Next. Any question you have, guys, don't feel shy. It's okay. My time is there. You can ask me any question. Okay, this is very nice. Saurabh Tripathi is asking this question. So Saurabh is saying, what is the difference between dividend funds and growth funds? Which one would you recommend to a new person in the stock market? Now, okay, let's understand what is dividend funds and let's understand what is growth funds. Now, all of you know what dividends is. Do people know what dividends is? If not, I'll explain, right? Now, when you buy a stock, when you buy a share of a particular company, you take part ownership in that company, right? If I buy shares of Reliance, I take part ownership in Reliance. I have one stock, right? Now, Reliance maybe will do a very good job over a period of time, and Reliance will say, you know what, I'm very happy, we made a lot of profit. I want to give some profit back to my shareholders for supporting me, right? And each share I will give them 1 rupee or 2 rupees, right? So that is basically every year or every quarter, if the company gives out dividends, it comes back into your bank account depending on the shares you have, right? Which is the company giving the money from their bank account to your bank account. Okay, then there are something known as growth funds. Now what growth funds basically says, now there is two types of ways to look at dividend fund and growth fund. Now if I am an individual, okay, who wants some money in my bank account every month or every year, some, ghar ka kharcha ke liye I want some money, something just passive income, right? So I'll invest some money into dividend funds, and every time dividend comes into that fund, they give me the money back into my bank account. So my daily kharcha is happening, right? But growth funds are slightly different. Growth funds are like, you know what, this is for people who don't want monthly income or monthly passive income from dividends. So what we'll do, when a company gives dividend, we will take that money, whatever the dividend is, we'll take that money, put it back into the stocks again, right? Like reinvest the dividends back into the stocks and push it for growth. Because now next time when dividends come, again it'll come, again you'll put it back, again you get dividends, again you take it, again you put it back, right? So this way the mutual fund will grow faster, because when it's dividend, half the money goes back to you, right? But when it's growth funds, it'll grow faster. So it all depends on what you want as an individual. Dividend gives you good passive income month on month, but growth funds gives you good long term wealth creation. Over a long period of time, you'll make more money. So Saurabh Tripathi, amazing question. Yeah, very good, very good, very good. Next. This is nice by Pankaj Nath. Pankaj, good question, man. How important is diversification of stocks, and does it help in getting more returns and reduce risk? Right. So, how important is diversification of stocks, and does it help in getting more returns and reduce risk? So, it definitely reduces risk. See, I'll tell you how it works. Right. Imagine I'm investing in one stock. Okay, what is my risk here? Almost I have only 10,000 rupees. Okay, I only have 10,000 rupees and I put all 10,000 rupees in one stock. Now I might think that that stock is the best stock in the world, right? But if that stock goes down tomorrow, I'm finished, my money will go, right? But if I take that same 10,000 rupees and split it with 10 stocks and invest 1,000 rupees in each stock, there might be two or three stocks that go down, but there might be seven stocks that go up, right? Whatever the average is. But here what I'm doing is I'm averaging this. So when I average it, my returns automatically get balanced and my risk get balanced, right? So does it help getting more returns? Not sure. But does it reduce your risk? Definitely reduces your risk, right? So diversification is very important. It's basically as equal to saying don't put all eggs in one basket. So that is how it is. Yeah. Next. Okay. One more question by Digvijay Singh. So Digvijay is asking, at the moment with markets at all-time high, does it make sense to go for direct equity investment, or is it prudent to invest in the market at an exact point? Now I'll tell you what, Digvijay, markets sometimes go up, sometimes go down. Nobody can time the market. Nobody can tell when is the perfect time to go and invest, right? Because you might think that no, the market is overvalued, it'll crash anytime soon. From the last 3 years, people are saying it'll crash. In fact, they didn't see a crash, they saw a bull rally happening, right? So a lot of people think that they can time the market. You cannot time the market, but what you can do is stay invested for a long period of time, because see, the market goes like this. Okay, it goes up down up down up down up down, but it slowly goes up, right? If you open BSE index and you see it from the last 25 years, you'll see it going like this, right? Up down, but it's always, overall trend is going up. So when you zoom out, it's always going up. So if it's actually going up, then why am I trying to time the market? I should just invest. And if it goes down and if the stocks are good, you keep buying more. So you average lower, right? So your average becomes better. So Digvijay, good question from you also. Very nice. Very nice. Next. Hmm. Okay, this is nice by Mona Patel. So Mona Patel says, how to judge a situation to exit from the mutual fund or stocks. Now, I have done a video on the Groww channel about when to exit a mutual fund. Now, mutual fund, sometimes what happens is when I'm investing in a large cap mutual fund, I want to invest in a large cap mutual fund, right? We will invest in large cap, give me good amount of returns. Now, the mutual fund's most important thing is the fund manager, who is the guy who is managing that mutual fund. Now, I am basically investing in the person who's running my mutual fund so that he can give me good returns, right? Now, tomorrow, if the fund manager changes and the new fund manager is not experienced, I might get scared. I might be like, you know what? I don't think this fund manager is good. I'm going to exit this, right? Sometimes what happens, this fund might change their philosophy. They'll be like, we're large cap, but what we're going to do slightly risky investments. We're going to do a little bit of small cap. Now, maybe that risky investment is not good for you. So when they change their allocation or objective, investment objective, that is when you can again withdraw and be like, I'm done, right? So a lot of different methods and techniques, or maybe you need the money. Maybe you suddenly urgent, you need the money and you have to withdraw right now. So that time you'll have to withdraw. So these are very important things to look at. So good question, Mona. Hmm. Hope you guys like this session. Please click on the like button. That will be nice. Should I invest in stocks also? I'm just looking at the questions. So any good questions, I'll take it on stage. Yeah. Awesome. Any good questions? I'm just looking at the questions one by one. Okay, Asif has a good question. He says, how did the mutual fund work in the past? Was it a good experience? So, guys, when you're investing in a particular mutual fund, you can check out how it has been performing from the last how many ever years as it's been inception, right? When it's gone live. So, if a mutual fund was started 5 years ago, you have the data of the last 5 years of the mutual fund. How much returns has it given every year? How much has it given? And what has it given in each year? Also, you can understand. Now you can cross check that with the competition of that mutual fund in the same category and check who's giving you better returns over a 5 year period or 10-year period, because you have to invest in a long period of time. So there are some mutual funds that don't do well. I'm not saying every mutual fund does well. There are some mutual funds that might not do well. Right. So it's always good to see a rating. There's a crystal rating attached to it. A credit rating company tells you whether this is a good mutual fund, 5-star rating, or bad mutual fund, 1-star rating. So you can go, all the information today is so nice for investors because we have every information available to us. All we have to do is be smart, connect the dots, and take advantage of this information. Yeah. Good, good, good. Next. Sorry, let me take this down. Okay, I'll do one thing. I'll take one last good question. One more good question. Let's take. Thank you, Asif. That was a good question. We'll take one more good question. Hope you guys are learning, because the main objective of this is to make you guys understand and learn how the stock market is, so that when you have knowledge, you can trade and invest smarter than most of the people out there. So always have knowledge, insane amount of knowledge required. Okay. Very good question. Okay, I'm going to take a damn good question in the end by Jatin Yadav. Jatin, very, very smart man. Kudos to you. Now, what he's saying is, considering passive funds have expense ratio in the range of 0.1 to 0.3 and actively traded funds have an expense ratio of 1 or more, which type makes more sense for someone starting on his or her investment journey? Now, there is two. Okay, I've done a very detailed video on this as well on the Growth channel about passive funds, and the difference between passive and active. Now basically, active funds are where a fund manager is actively looking at different stocks, removing them, putting them back in, trying to beat the index so that you are very beneficial at the end of the day. Then there is something known as passive funds like ETFs, right? Exchange traded funds, index funds. Now what happens in a passive fund is basically the fund manager is just copying something, right? Copying an index or replicating an index. He sees Nifty, you want to invest in Nifty? Okay, we will copy the Nifty index. So now here, there's not much effort required. He has to just change it whenever there's a small change. So what happens is I don't need a team of 50 people under me. What happens when I don't need a 50-man team under me? My expense ratio for that goes down. I don't need to charge my clients so much to manage everything. So what happens is the expense ratio becomes lower so that you get more returns in the end of the day, right? Whereas in mutual funds, they take 1% or 2% sometimes, which is sometimes very high also. So if someone wants to invest in the journey, now understand this, how it works, right? Active funds are fund managers who want to beat the market index, right? If the market is giving 15%, fund manager wants to get 17% and beat the index. So you're paying that extra expense ratio for that premium of 2%. But sometimes they can't beat. They try to beat, they can't beat. Then passive income makes sense. So if you're saying, you know what, I don't want this game of beating and non-beating, I just want to invest in the index and just sit for 10, 20 years, then passive income is best, right? The passive funds are best. So that's when you invest in passive funds. So it depends on you, but a lot of people I know are, moving towards passive income. There's a lot of talks about passive funds. I think Warren Buffett also recently spoke about people who don't understand the stock market, people who are scared of the stock market should look at passive investing, which is, index funds. I've done a video about this with Warren Buffett as well, so you should definitely watch it. Awesome. Now, I hope you guys liked this video, right? Please, if you like the video, I want you guys to say thumbs up or liked it, anything, up to you. right? Also, I'm going to share a link, which is a feedback link. So if you like this session, please rate on that. That is a feedback link. So if I've done anything wrong, I can learn and make it better for the people coming ahead, and for other things as well. So again, hope you guys like it, hope you guys enjoyed it. Again, please keep learning as much as possible. See, the feedback link is up there, so please keep learning. All the people from IIM Shillong, all the people from FMS, you are a great crowd, amazing crowd, loved it. And some really really good questions from you guys. So I love all that. I like it when people are so interactive. So again, thank you guys for spending this 1 hour with me. Thank you guys for learning with me, and hope to see you guys soon. Please keep educating. Please come for the Groww Masterclass. Massive amount of knowledge there. So don't miss out on these opportunities. Yeah, awesome. Thank you guys. This is me, Shashank Udupa, signing off.